Howdy everyone, on today's show we have Smokey and her associate. They both have an accounting dilemma. I'm going to help Smokey with the objectives of financial reporting. Now Smokey, can you tell our viewers about your situation?
I operate a factory in a jurisdiction that enacted the legislation in October 20 of the 13 requiring smoke filters for all factories. This legislation requires installation by December 31st, 20 of the 14, and failure to comply will result in a fine assessed annually. I'm definitely not going to install the filters. I will instead pay the fine. How do I account for this obligation for this year, 20 of the 13, and next year, 20 of the 14?
Okay, Smokey, great question. First, let's discuss the relation of this obligation with the elements of the financial statements. This obligation matches the FASB's definition of a liability in Concept Statement 6, which states that liabilities are probable future sacrifices of economic benefits arising from present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of past transactions. So now, as of December 31st, 2013, you do not have a liability because you have an entire year to install the filters and satisfy their obligation. Now next year, December 31st, 2014, you will need to record a liability. The obligation will then be a present obligation because it relates to past events of not installing those filters by the deadline. This event will result in the sacrifice of economic benefits from incurring the annual fine. This sufficiently meets the FASB's definition of a liability.
What journal entry would I have to record, and where would this show up on my company's financial statements?
Okay, Smokey, you will need to record a debit to an expense account for the fine, and you would have a credit to accounts payable. This expense will show up on your income statement as an increase to your overall expenses. Now the liability will show up on your balance sheet as an increase to overall liabilities. The initial measurement of the liability will be recorded at the nominal amount of the fine levied against you by not installing those filters by the deadline.
Would I continue to make this journal entry after subsequent years after 20 of the 14?
Yes, Smokey, you would. At the end of each year, if you have not installed the filters, then at that deadline of December 31st, you would record the journal entry for the amount of the fine that is imposed against you. Now, subsequent measurements are not an issue with this scenario because the liability will be paid off during the following year. If the fine is not paid in the following year, then you would need to review over this new legislation to see if you will acquire additional fees from not paying in the appropriate time frame. This could result in the past due fine be measured at fair value or modified historical cost.
Okay, now I know what to record. I want to know how this journal entry follows the purpose of financial reporting. In other words, why is this journal entry needed for the 20 of the 14 financial statements?
Okay, Smokey. Well, first of all, let's discuss the purpose of financial reporting. In Concept Statement 8, the FASB stated the objective of financial reporting is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. In order for this information to be useful, the information provided in the financial statements must utilize the qualitative characteristics that are addressed in Concept Statement 8. Now, there are two fundamental qualitative characteristics and four enhancing characteristics. We are now going to talk about those. First, the two fundamental characteristics are relevance and faithful representation. Now, recording the liability is relevant because it provides predictive and confirmatory value. By seeing the liability on the balance sheet, financial statement users will be able to predict that this will be a recurring obligation related to this new legislation. This liability is confirmative because it provides the user with feedback about the entity's obligation. Now, the inclusion of this liability on the financial statements faithfully represents the economic reality of not installing these filters by the December 31st deadline, and therefore having to have this liability for the amount of the fine. This transaction is complete, neutral, and free from error. Now let's discuss those four enhancing characteristics, which are comparability, verifiability, timeliness, and understandability. First of all, the financial information is comparable because it can be compared with other entities that are subject to this new legislation. Therefore, other companies like Smokey that need to install these filters in their factories. Next, the financial information is verifiable because the recording of the liability is in line with accounting standards, and other entities would reach the same consensus about recording the liability at the end of the year. In addition, the financial information has a timeliness factor because the liability is included in the financial statements, which are available to decision makers in time to influence their decisions about providing capital. Lastly, the information is understandable to decision makers because the liability is presented clearly and concisely on the balance sheet of the financial statements.
Alright, I understand. By recording the liability, my company's financial statements possess all of the qualitative characteristics. Therefore, my company will be able to provide financial information that will be useful in the decision-making process of the users.
Yes, Smokey, you are correct.
I never realized how important one little liability could be. Thank you for all your help. I would hate to mislead my shareholders and creditors. I need their capital to finance my factory operations.
Well, Smokey, you are welcome. And that concludes today's episode of Accounting 101. Thank you very much for joining in.
Jenkins and I have a question.
Yes, sir, Smokey?
Will you do my taxes?
I'm sorry, but I'm an auditor. I don't do taxes.
You said no.